Have you ever glanced at a company's balance sheet and maybe just zoomed past the stockholders' equity section, thinking, okay, that's the owner's piece?
Yeah, or maybe you've seen terms like Treasury stock or APIC additional paid-in capital and sort of wondered what they really mean.
Exactly. It seems simple on the surface, right? Assets minus liabilities equals equity.
It does. But really understanding what makes up that equity, who the different types of owners are, what rights they have, what obligations might be tied to their stock, that's where the real story is.
And that's what we're digging into today. We're doing a deep dive using source materials straight from, well, the accounting guidance itself, specifically how companies have to present and disclose info about their stockholders' equity.
Right, and we're looking at guidance that's been updated fairly recently, reflected in a document from May 2022.
So our mission here is really to unpack all this detail. We want to navigate these rules together and pull out the essentials so you can understand what companies actually have to tell you about their ownership and related deals.
Because it can seem like a maze. Different stocks, different rules, but getting a handle on these disclosures is absolutely key if you want to properly evaluate a company's financial position.
Okay, so let's start at the beginning. Fundamentally, what is stockholders' equity?
At its core, it's the owner's residual claim. Think of it like this. After all the company's debts and liabilities are paid off, whatever assets are left belong to the stockholders. It's their stake.
And you see it right there on the balance sheet.
You do. But, and this is a really critical point from our source material, the balance sheet number, that's just the summary. The important context, how it changed, the breakdown of the different kinds of equity, their specific terms.
That's hidden deeper.
Often, yeah. It's usually in the footnotes to the financial statements or in a whole separate statement called the Statement of Changes in Stockholders' Equity.
Right, the balance sheet's the snapshot, but the movie, the details, they're elsewhere. And companies don't just share this stuff out of kindness, do they?
No. These presentation and disclosure rules are mandated. They come from authoritative bodies.
Like who?
We're talking about standards set by FASB, that's the Financial Accounting Standards Board. They set the rules for US GAAP and also rules from the SEC, the Securities and Exchange Commission, especially for public companies.
Okay. And speaking of specific guidance, our source mentions some key standards. What are the main ones governing stockholders' equity?
Well, the core accounting guidance is primarily in ASC 505, which covers equity broadly. And then there's ASC 81540, which gets really specific about contracts involving a company's own equity, things like warrants, convertible features, that kind of thing.
And the SEC adds more layers.
Oh, definitely. Especially for public companies. The source points to SEC's Regulation SX, particularly rules like SX 304, 502, 407, 408. These dictate exactly how financials filed with the SEC need to look. And there's an older one, ASR 268, Accounting Series Release 268, which is still important, particularly for how certain redeemable stocks are classified.
The source also flagged some new guidance. What's the big recent update we should know about?
That would be ASU 2020-06. That's FASB Accounting Standards Update 2020-06. The main goal here was to, believe it or not, simplify the accounting for some of these complex instruments that have features of both liabilities and equity.
Simplified in accounting. That's always welcome news. So what specifically did ASU 2020-06 change based on our source?
It mainly streamlined the accounting for convertible debt and convertible preferred stock, getting rid of some of the more complex models. It also changed how companies assess certain features in contracts involving their own stock, which affects whether they get classified as derivatives or as equity.
And when did companies have to start using this new rule?
Okay, so for public companies' SEC filers, it was effective for fiscal years starting after December 15, 2021. For everyone else, it was fiscal years starting after December 15, 2023, though early adoption was permitted.
So if you're looking at financials from 2022 or later, you're likely seeing the effects of ASU 2020-06.
That's right, good chance.
Okay, let's pivot from the high-level guidance to one of those places with the crucial details, the statement of changes in stockholders' equity. What's its purpose?
This statement is incredibly useful. It doesn't just give you the ending balance for each equity component. It actually shows you how you got there. It reconciles the beginning balance to the ending balance for the period, detailing all the transactions that caused those changes.
So you see the story of equity over the year. What's the typical format?
The source mentions a common columnar format. So picture columns for each key piece, common stock, maybe different classes of preferred shares, additional paid-in capital, API, retained earnings, accumulated other comprehensive income, AOCI,
And importantly,
And importantly, it has to separate the equity that belongs to the parent company's shareholders from any non-controlling interests, then usually a total equity column.
you mentioned APIC and AOCI there. Can you just quickly define those again?
Sure. APIC, additional paid-in capital, is basically the cash companies get from selling stock that's above the stock's par value. It's sort of nominal legal value. It's extra capital contributed by shareholders.
Got it. And AOCI.
AOCI, accumulated other comprehensive income. That's a bit more complex. It's like a holding tank for specific types of gains and losses that accounting rules say shouldn't flow through the main income statement right away. Things like unrealized gains on certain investments, foreign currency adjustments, certain hedging impacts. They build up in AOCI over time.
Okay, makes sense. So back to the statement of changes, what kinds of movements would we see in those columns?
You'd see the net income or loss for the year hitting retained earnings. You'd see impacts from stock-based compensation expense, any new shares issued, common or preferred, any shares the company bought back, Treasury stock activity, and, of course, any dividends declared or paid out.
So it really tracks everything that affects equity, and companies have to show this.
Yes. Either as a separate statement or laid out clearly in the footnotes. Users have to be able to see how those equity balances changed.
You also mentioned non-controlling interests, NCI having its own section or column. Let's unpack that. What exactly is NCI?
Right. NCI represents the slice of equity in a subsidiary company that the parent company doesn't own. So imagine big company owns 80% of small company. When big company prepares its consolidated financial statements, it includes 100% of small company's assets and liabilities. That remaining 20% ownership stake held by others. That's the non-controlling interest.
Okay, so it's part of the total equity of the combined entity, but it belongs to those outside owners of the subsidiary. And the guidance requires specific details about changes in NCI.
It does. ASC 810 requires a reconciliation basically showing the roll forward from the beginning NCI balance to the ending balance. And this reconciliation needs to separately show the net income or loss that's attributable to the NCI holders, any capital transactions with those NCI owners, like contributions or distributions, and their share of any other comprehensive income activity.
Now, this connects to something the source mentioned about classifying certain NCI, specifically this mezzanine classification. What's that about, especially with redeemable NCI?
Ah, yes, mezzanine equity. This is where presentation gets interesting. If that non-controlling interest has a redemption feature, meaning the parent company might have to buy it back under certain conditions, maybe at the option of the NCI holder, then SEC guidance, stemming partly from that ASR 268, says you can't just lump it in with the parent's permanent equity or even the rest of the NCI.
So where does it go?
It gets classified as mezzanine equity. It's presented on the balance sheet separately, physically located between total liabilities and permanent stockholders' equity.
And mezzanine signifies?
It signals that while it's currently an ownership interest, there's a potential future claim on the company's assets. The company might have to pay cash to redeem it. It's not quite debt, but it's not quite permanent equity either.
That distinction feels important, and it affects how you calculate things like book value per share for the parent's owners, right?
Exactly. It provides a clearer picture of the equity that's truly permanent versus equity that might walk out the door someday.
Okay, let's broaden out again. Beyond specific statements, the source talks about general disclosures needed for all classes of securities a company has out there. Why is this so important?
It's pretty fundamental. If you're an investor or even a creditor, you need to understand the terms of the deal. Companies must disclose the key rights and privileges tied to every type of security they've issued, common stock, preferred stock, warrants, whatever. You need to know what you own or what rights others have.
Makes sense. What are some specific examples of these required disclosures? The source listed quite a few.
Yeah, the guidance is pretty explicit. ASC 505 lays it out. Companies need to disclose things like dividend preferences, who gets paid dividends first, and liquidation preferences if the company dissolves, who gets their money back first and how much.
Okay, so payout order. What else?
Participation rights. Does preferred stock get extra dividends if common gets a big one? Call prices and dates. Can the company force you to sell your stock back to them, and when, and for how much? Sinking fund requirements. Are there mandatory periodic redemptions for preferred stock? Any unusual voting rights? All that needs to be disclosed.
Seems crucial for understanding power dynamics and potential returns.
Absolutely. Plus, terms of significant contracts to issue more shares later. And for anything convertible or exercisable, like convertible debt or warrants, they need to disclose anything that could change the conversion or exercise price, including standard anti-dilution clauses. They have to spell out the actual conversion or exercise prices, the relevant dates, how many shares get issued upon conversion, and disclose any actual changes to those prices that happen during the year.
That's a ton of detail just on the terms. I also saw something about disclosing discounts on shares.
Right. If shares were somehow issued at a discount to their par value, less common now, but possible that discount has to be disclosed separately. It's shown as a direct reduction from the related stock account on the balance sheet, basically reducing the equity attributed to those shares.
Okay, good overview. Now let's dive into the specifics of the major equity components, starting with the most basic, common stock.
Right, common stock. This is typically your basic ownership interest. Common stockholders usually have voting rights, and they hold the residual claim, meaning they get whatever's left over after all debts and preferred claims are satisfied. Last in line, essentially.
How does it typically show up on the balance sheet, according to the rules?
SEC rules, like SX 502, generally require companies to show the dollar amount assigned to common stock and the number of shares issued and outstanding. Now, if a company has different classes of common stock, maybe Class A with super voting rights and Class B with regular rights, they might just show one line for common stock on the balance sheet itself.
But the details.
But they absolutely must break down the specifics for each class in the footnotes.
And what are those specific footnote disclosures for common stock?
Things like the official title of each class, for example, Class A, common stock, the total number of shares the company is legally authorized to issue, and if any class is convertible into something else, the terms of that conversion. Also, details about shares that have been subscribed for but not yet fully paid for or issued, and any receivables related to those subscriptions.
Okay, common stock seems, well, relatively common in its requirements. Let's move to preferred stock. This is where it gets trickier, right?
It certainly can, yes. Preferred stock gets its name because it has preferences over common stock, usually for dividends and liquidation payouts like we mentioned. But the big question for accounting is it really equity? Or is it something else?
And the answer depends on.
Almost entirely on its redemption features. Can the company be forced to redeem it? Does the company have to redeem it? Does the holder have an option? These features dictate whether it's classified as permanent equity, mezzanine equity, or sometimes even a liability.
Okay, walk us through the main scenarios. What about preferred stock that's genuinely perpetual, no redemption obligation at all?
Right. If it's truly perpetual, meaning the company has no obligation to ever buy it back and the holder can't force redemption, then it's generally classified as permanent equity. So it's right alongside common stock and APIC. Disclosures are pretty standard.
Yeah.
The title, dollar amount, shares authorized, issued, outstanding.
Okay, permanent equity. Now, what if the company has the option to redeem it? Or maybe it's exchangeable for cash at the company's choice.
Yeah, now we're likely in that mezzanine equity zone again. Because there's a potential future cash outflow, even if it's at the company's option, the SEC guidance, ASR 268, SX 502, says you present it outside of permanent equity. You can't combine it into one line item with common stock or retained earnings.
So even the possibility bumps it out of permanent equity. What disclosures are needed for this mezzanine type?
You need to disclose the title, its carrying amount on the balance sheet, importantly, the amount the company would have to pay if it did redeem it, and the usual details on authorized, issued, and outstanding shares.
Okay, here's the big one impacting the balance sheet structure. What if the preferred stock is mandatorily redeemable? The company must buy it back at a specific time or upon an event that's certain to happen.
This is a crucial distinction. Mandatorily redeemable preferred stock under ASC 480 is not equity, not permanent, not mezzanine. It's classified as a liability.
A liability, really, even though it's called preferred stock.
Absolutely. If the company has an unavoidable obligation to hand over cash or other assets to redeem those shares, the accounting treats it essentially like debt. Think about it, behaves like debt.
Wow, that dramatically changes things like debt-to-equity ratios, doesn't it?
Hugely. It makes the company look potentially more leveraged. The disclosures required are also more like debt disclosures.
Such as?
You need to disclose the nature and terms of the redemption obligation, any related rights, how it can be settled, the actual amount that has to be paid, and how changes in its fair value are being accounted for, if applicable.
Okay, one more scenario. What if it's contingently redeemable based on something outside the company's control? Like, if there's a change in control of the company, the holders can force redemption.
That's generally another ticket to the mezzanine section, presented outside permanent equity. And for these, there's a specific requirement under ASC 505 and SX to disclose the amounts and timing of redemption requirements for the next 5 years. Gives users a heads up about potential near-term cash needs.
Got it. that clarifies the redemption impact. Now, let's layer on another complexity. Convertible preferred stock. Preferred stock that can be turned into common stock.
Right. Convertible preferred adds another dimension. Now, its initial classification, permanent or mezzanine equity, still hinges on those redemption features we just talked about.
Yeah.
Non-redeemable, likely permanent equity, redeemable at issuer's option, or contingently outside issuer control, likely mezzanine.
Did that ASU 2020-06 change much for convertible preferred disclosures?
Oh, significantly. After adopting ASU 2020-06, the disclosure requirements for all types of convertible preferred stock really expanded. The goal is much greater transparency.
What kind of specifics do they need to disclose now?
It's pretty comprehensive. The nature and terms of the conversion feature itself, how the instrument is actually reflected on the balance sheet and income statement, details about any events or conditions that could trigger or change the conversion terms, and all the key rights and privileges, dividend rights, the conversion price or ratio, when it can be converted, how it settles, shares, cash, or a mix, its liquidation preference relative to common voting rights.
And if conversion only happens if, say, the stock price hits a certain target?
Yes, those contingent conversion features need detailed disclosure, plus any discount the stock was issued at.
What if there are other related bits, like detachable warrants issued alongside the convertible preferred?
Good question. If there are separate related derivative instruments, then the derivative accounting rules in ASC 815 kick in. The equity guidance specifically points you there, requiring disclosures about those derivatives and how they link back to the convertible preferred stock. It's all about showing the whole picture of these complex instruments.
And that complexity isn't limited to preferred stock. Companies have other contracts involving their own shares, right? Like warrants or forward purchase agreements.
Exactly. Things like freestanding warrants, forward contracts to repurchase shares, even features embedded in convertible debt. These often fall under ASC 81540, contracts in entities' own equity. Their classification as equity or a liability or sometimes an asset depends on detailed criteria, particularly around how they settle physical shares versus cash and who has the choice.
And the disclosures for these, especially after ASU 2020-06.
Very similar, again emphasizing transparency. You need the nature and terms, the impact on the financials, potential effects of future events. For contracts specifically indexed to the company's own shares, you need to disclose things like the forward rate or option strike price, number of shares involved, settlement dates, and the accounting treatment. Plus, details on settlement alternatives and the potential range of shares that could be issued.
Okay, let's shift gears to something that feels a bit simpler on the surface. Retained earnings.
Retained earnings.
Yeah.
Conceptually simple, yes. It's the cumulative net income the company has earned over its entire existence, minus all the dividends it's ever paid out. It's the profit the company has kept and reinvested in the business.
But even here, there are important disclosures, especially about restrictions.
Absolutely. Just because a company has a big retained earnings balance doesn't mean it can actually pay all of that out as dividends.
Yeah.
Various things can restrict that ability.
Like what?
Common sources or state laws. Many states have rules to protect creditors by limiting dividends if capital is impaired. Loan agreements often have covenants restricting dividends based on financial ratios or earnings levels. And sometimes, if a parent company relies on dividends from its subsidiaries, there might be restrictions on the subsidiary's ability to send cash up.
And companies have to tell us about these restrictions.
Yes. SEC rules, SX08E, require disclosure of the nature and amount of the most significant restrictions on retained earnings available for dividend payments. It tells users how much of that accumulated profit is actually free.
I've also heard the term appropriations of retained earnings. What's that?
Less common nowadays, but sometimes a company's board might formally designate or appropriate a portion of retained earnings for a specific purpose, maybe to cover potential losses, or to fund future Treasury stock buybacks, or to earmark funds for preferred dividends that are in arrears. If these appropriations are material, they might need disclosure just to clarify that this portion isn't available for general dividends either.
Okay, let's talk Treasury stock. What is it again?
Treasury stock is simply when a company buys back its own shares that were previously issued and outstanding in the market.
And how does it show up on the balance sheet?
It's almost always shown as a reduction, a contra account within total stockholders' equity. The company uses cash, an asset, to reduce the outstanding ownership claims, equity.
What do companies need to disclose about their treasury stock?
Key disclosures under ASC 50530 include the method used to account for it, usually the cost method, They also need to disclose the number of shares held in Treasury and, importantly, any commitments the company has made to repurchase more of its stock in the future. The source also notes other potential disclosures, like any state law restrictions on Treasury stock purchases, and perhaps the reasons why the company is buying back its stock, if it's significant.
We've hit the big ones: common, preferred, NCI, retained earnings, treasury stock. Any other key equity concepts from the source we should touch on?
Well, we mentioned additional paid-in capital, AP, briefly, the excess over par value. Another huge one is dividends, distributions to shareholders.
Which can be cash, stock, or even property, right?
Exactly. Cash and property dividends typically reduce retained earnings directly. Stock dividends issuing more shares instead of cash are a bit different. They usually involve transferring an amount from retained earnings to the common stock and APIC accounts, reflecting the capitalization of earnings into permanent capital. Disclosure is needed for the number of shares issued.
What if a stock dividend is declared but not yet paid out?
Classification there, liability or still equity, depends on whether a from legal obligation has been created. If so, might be a liability until paid.
And liquidating dividends, that sounds ominous.
It just means the dividend isn't coming from profits, retained earnings. It's a return of the shareholder's original investment or capital. So these reduce APIC or maybe even the common stock account itself. They definitely require disclosure so users know it's not a distribution of earnings.
The source also mentions stockholders' rights plans, poison pills.
Right. Those are anti-takeover defenses. If a company has one, they need to disclose its basic nature in key terms, like call provisions, so investors understand the potential impact on control changes.
Okay, last one maybe, stock splits. How are they different from stock dividends, accounting-wise?
Both result in more shares outstanding, but a stock split is usually a much larger issuance, often done primarily to reduce the market price per share and increase trading liquidity. Accounting is often simpler, maybe just adjusting the par value per share and the total share count, sometimes with no change to total equity or retained earnings. A stock dividend is often smaller and framed more like a distribution. The labeling matters. GMAM prefers calling a split affected in the form of a dividend rather than just a stock dividend if it meets certain size criteria.
But for calculating earnings per share, EPS, they're treated similarly.
Correct. Both stock splits and stock dividends require retroactive adjustment. You have to restate the weighted average shares outstanding for all prior periods presented in the financial statements, so the EPS figures remain comparable over time.
It seems like a company's capital structure can really shift dramatically at key moments, like an IPO.
Oh, absolutely. An initial public offering is often a trigger for major capitalization changes. You frequently see outstanding convertible preferred stock or convertible debt automatically converting into common stock right before or upon the closing of the IPO.
And disclosure is needed there, too.
Yes. Companies going public need to provide pro forma information showing the impact of these significant conversions on the balance sheet, the capital structure, and on historical earnings per share, as if the conversion had happened earlier. This gives potential IPO investors a clearer picture of the equity structure they're actually buying into.
Now, a lot of what we've discussed, especially the SEC rules like SX and ASR 268, sounds very public company focused. What about private companies? Do any of these detailed equity rules apply to them?
That's a fair question. While the heavy SEC regulations don't apply directly, private companies reporting under US GAAP still have equity disclosure requirements. For instance, that rule about disclosing redemption requirements for redeemable preferred stock for the next 5 years. That applies to private companies too under ASC 505.
And the general idea of disclosing rights and privileges.
Yes, the basic GAAP requirement in ASC 505 to disclose the pertinent rights and privileges of all outstanding securities applies broadly. And while not SEC rules per se, guidance like FASB Topic 4C on disclosing capital structure changes around offerings can be relevant context, even for private companies seeking investment. Their lenders, owners, potential buyers, they all need transparency too.
It's really quite something how digging into these presentation and disclosure rules reveals so much more than just a single equity number.
It really does. It forces companies to articulate the nuances: who owns what are their rights, and critically, are there features embedded in that equity that could potentially require the company to pay out cash down the road.
So for someone looking at the financials, the big takeaway is
You absolutely cannot just look at the total stockholders' equity line on the balance sheet and call it a day. The classification matters immensely. Whether something is labeled debt, permanent equity, or sits in that mezzanine category tells you fundamentally different things about the company's obligations and financial structure.
So here's something to think about. We've discussed these incredibly detailed rules, especially around things like redeemable preferred stock, where classification hinges on specific features. Consider how critical it is for a company to get that classification liability, mezzanine, or permanent equity exactly right. It massively impacts their reported financial health. And for you, looking at those statements, understanding why an instrument called stock might actually be sitting closer to liabilities gives you a profoundly deeper insight into the company's real commitments than just accepting the label at face value.